At London Financial Studies, we focus exclusively on capital markets. Our programs offer practical learning to professionals from all over the world. Public courses are delivered in London, New York, and Singapore. Our teachers are leading experts in their fields with a wealth of practical knowledge. They are skilled communicators who can get the message across quickly and effectively.
I'm delighted to welcome Dr. Jamie Walton for our LFS videocast. Jamie has over 18 years of experience as a quant in financial markets, including 10 years as head of FX quant at Morgan Stanley, where he built the team of FX electronic trading. He's also an honorary research fellow at UCL, where he lectures for the master's program in financial mathematics. Jamie teaches at LFS, among other things, the course on MiFID II. And this videocast is about MiFID II today. So welcome, Jamie. Thank you. Let's start with the first question that is on everybody's mind. The introduction of MiFID II is just less than a month away, and banks, asset managers, financial institutions in general are scrambling to prepare. This is a massive regulatory overhaul, and there are obviously a lot of concerns. Can you give us a brief background of this directive, Jim?
Yes, absolutely. So MiFID II is actually an update of the original MiFID regulation, which came out in 2007. And the go-live date is 3rd of January in 2018, with the aim of trying to expand the scope of the original MiFID specification into new marketplaces, into fixed income marketplace in particular, and also to take into account a response to the financial crisis. There was a sense that MiFID I did not go far enough with investor protection, and so MiFID II is an update of that regulation.
Yeah, that's interesting. So we have the old MiFID and now the new MiFID II. What is the difference between the two in detail?
Yes, so MiFID I was focused on equities in particular, and the idea there was to, first of all, encourage further institutions, to open up institutions that can trade, exchange-like venues to trade equities, which are called MTFs, multilateral trading facilities. So that was one of the aims. It's also wanted to make what the concept of systematic internalizer, which is a market maker that's internal to an investment firm. However, it didn't really succeed in that area. Only 11 firms ended up announcing that they were systematic internalizers. So there was a sense that had failed. It hadn't had enough scope or breadth in its implementation. So particularly with the financial crisis, it was seen that more regulation in Europe was required to focus on, firstly, investor protection. How can we make sure that investors' money is protected? How can we make sure that the banks will do the right thing to make sure the client is considered first? Secondly, it was trying to open up transparency in the markets. So how can we make those markets available to more market participants? How can we make the information and the data available more available to other smaller market participants instead of having a monopoly of the bigger players having all of the information? The third aim was more to do with resilience of the market. So they didn't want to repeat the mistakes of the financial crisis. So what could we do from a regulatory point of view to try and enhance the safeguards within it? One of the aspects there was to look at the algorithmic trading component and to increase the aims of protecting the systems from anything going wrong in algorithmic trading.
That's very interesting. And as we mentioned, now is a crucial time. We are less than a month away from the introduction. Is this gonna happen for all the firms and all the countries at the same time, or are there different dates and of implementation?
Well, the go-live date is 3rd of January. That's a hard date. Now, there's a difference between MiFIR and MiFID. MiFIR is the Market in Financial Instruments Regulation, which is a European regulation. MiFID itself, the D stands for Directive, and is the requirement for each regulatory body in each country to set their own rules, their own laws in action to represent MiFIR, I should say. So that is underway. Most countries, most regulators have set their standards. And so the go-live date is the same for everyone. There are minor changes between countries in what you can do and how that's implemented, but they're more around the margins. Most of the rules are largely the same. Now, in terms of the go-live date, that has been rolled back a year already. The European Parliament has made it clear they're not going to roll it back again. So this is a line in the sand. 3rd of January will be the go-live date, and all firms will be examined to see how far they're complying with MiFID II. That's not to say in certain areas there may be a little bit of leeway, particularly where the more complex rules are coming into play. One of the changes is around liquid products. And if you're trading a liquid instrument, then you need to register as a systematic internalizer if you're market making in that instrument. The definition of what is a liquid product cannot be ascertained until they have enough data from all the European firms. So particularly in the fixed income space, it is not yet apparent what is a liquid notional amount for, say, a foreign exchange option, because that data is not available. So the data will be collected over the first 6 months of next year, and the actual go-live date in those instruments will be September 2018.
Understood. And it seems there are a lot of requirements that both for buy side and sell side companies that are new. And at the very beginning, I remember when the first MiFID was introduced, there were not really critics from the industry, because it was soon after the financial crisis and everyone in the industry felt a little bit guilty. But now we hear some people in the industry complaining about the cost of MiFID, while at the same time others say that it's an opportunity. What do you think? Where do we stand?
Well, there's no doubt it's been a major cost for all the banks. The MiFID bill, if you like, is estimated to be around $3 billion for European firms. So it's a major IT implementation exercise. But the benefits are much broader, and I think firms are now waking up to what the potential benefits of the new structure will be. It will lead to market structure changes, but one of the benefits is around transparency of the markets. So that transparency will mean that all people will have information about what trading has happened by their counterparties. It means from a client point of view, if you're on the buy side, you'll be able to see the quotes that banks are making to your competitors to see whether you're being treated in line with those competitors. And then in the market making point of view, there's going to be the opportunity to do your own market making as a systematic internalizer, to have more venues where you can execute. So that will increase hopefully the liquidity of the marketplace, at least the types of exchange-like venues, the MTFs, where you can exchange.
Okay, so costs, but also good opportunities for firms. LFS headquarters is in London, and the big elephant in the room these days is Brexit. How is this going to have an impact on MiFID II in UK? And I'm thinking in particular about, for example, passporting of the licenses.
Yes, well, that's a big question, of course. There is some hope that, the current aim of the government is not to have the hard Brexit. We'll see if that changes over time. So the aim is to have a transitional agreement to cover all of MiFID until 2021. So, in fact, European institutions, British institutions will be subject to MiFID under the current aims until 2021. So that's some period of time where everyone will be compliant. Now, the passporting question is quite important. So under passporting, if you are regulated by any European body, you're automatically regulated by all others. That's the intention, so that you don't need to seek regulatory approval from all 28 countries in the EU. Now, the city is clearly wanting to retain those passporting rights, because to lose those would mean an increased burden on UK companies, and in fact probably the need to set up more European entities and to move more people into European centres from London. So that's a major change. And so I think there's a lot of lobbying to make sure we keep passporting rights. One of the requirements that the European Parliament is suggesting is we at least need to have our regulations as strict as MiFID II. So I don't think we're going to get any sense of watered down regulation occurring in UK if we want to keep those relationships with Europe, which, let's be clear, is 70% of the UK trading partners.
That sounds like armed negotiation
Yes.
in that respect too. But there are other consequences from MiFID, especially the big changes in terms of mentality. I think it is with regard to research, both on from the buy side and sell side. What are the new regulations there?
Sure. So under the new regulations, the aim for transparency has meant a shift towards unbundling research from other trading opportunities that banks provide. So traditionally, research was often offered for free, as a service to clients in exchange for doing business. The regulations are now saying that the cost of that research must be clearly stated to the client, so that they need to take it out of, say, the fee they're charging for a service or the bid-offer spread they're charging for a trade. They need to actually make it explicit what they're paying for that. Lots of banks have now come out and put costs on their research. So you can say, well, you can buy our research for $20,000 a year or whatever it is. So you are getting that change. I think the bigger change is on the research side. What now is the advantage of being in research in an investment bank? So you cannot benefit from being paid out of trading business. Also, the Chinese rules mean you don't have any privileged information from the trading side. So I think one of the changes we may see over time is that research becomes taken out of investment banking. It even becomes its own business, its own entity in its own right.
So there might be, a future user in research, even in UK, for independent analysts.
Yes,
probably.
Absolutely.
You have mentioned a few times that MiFID is gonna change the market structure. What do you mean with that?
Yes, so let me focus on 3 or 4 aspects within MiFID. So the first one I want to talk about is called pre-trade transparency. And that's around making sure that when a quote is made to a client, then that same quote is made available to other clients to trade. The aim here is that a preferred client doesn't get better rates than everyone else, but there's a more level playing field. So that's going to change the market structure, because currently in fixed income that doesn't happen. In equities, we're used to going to the exchange and everyone sees the same share price. That does not happen in the fixed income space. So that's going to naturally lead to more transparency around where the market is. There's no centralized tape. Also more transparency around making sure that every client is seeing the same kinds of price. Of course, credit risk, market risk is taken into account, so you can update your price over time. But the intent is to show that the price you're seeing your competitors getting should be available for you as well. So that's the pre-trade transparency on the quoting side. On the post-trade transparency, we're going to see all trade information and in great detail, in much greater detail than MiFID I, being posted into publicly available venues, APAs as they're called. That data will be free after 15 minutes, so anyone can download it for free. Before then, equities data needs to be posted within a minute. For fixed income, that's going to be within 15 minutes, although that will go down to 5 minutes in 2021. So what you're going to see from a market point of view is, with all this transparency around the trade, you're likely to have more market impact when you do trade. People will be able to see what you're trading, and that may cause the market to move further, may move even against you further because of that transparency. Now, what you've seen in the equities market is this bifurcation of trading between large block size trades and smaller, trades on exchange. In fact, the average size of an equity transaction on the New York Stock Exchange now is something like 180 shares. That's the average ticket size. So you get either 180 shares or you get some large block size of, worth $1 million or several $1 million. And I think that bifurcation you're going to see happening in the fixed income space for the same reason. So if the trade is large enough, then counting as a block size, larger in scale is the wording for block size in MiFID II, then you don't have to report it. So that will mean you don't have to have the post-trade transparency. So if you're trying to disguise your trading intentions, it's likely that you will either want to go to the block size or on the counter side, trade in much smaller amounts using algorithms to hide your intent. So those are two areas. The third area I wanted to mention is best execution. This is already a requirement in equities, the need to prove that you've got the best possible result when you trade on behalf of a client. This is now going to extend into fixed income. And the transparency and the metrics, the data required to do that is a fundamental shift in the fixed income marketplace.
Yes. Yeah, absolutely true. I am a fixed income, ex-fixed income practitioner, and that's absolutely true that the change there is going to be massive. We would like to thank Jamie for his time and remind everyone that Jamie teaches a course on MiFID, of course, among other things, London Financial Studies. Thank you.
Thank you very much.